how can we know the real price of anything if we don't have a reliable measuring tool? And the US dollar, the pool of US dollars and the pool of total credit in the world just seems to be expanding at a never ending pace, at an accelerating pace. Look at the gold price. And what is fascinating is about since the last time you and I spoke, which was about a year ago, I think the price of gold per ounce at that time was about $2,450, so just over $2,400 an ounce. Today it's about 4,000, and that's down from close to 4,400 about a week or two ago. So it's nearly doubled in about a year. The inflation could really, the cost of living and price inflation could really get out of control and probably become very bad. If what we're talking about, if there's a reversion to the mean in the real price of oil, and the real price of things like gasoline and food products, if that happens, what we've seen so far could be dwarfed by the type of inflation that could be down the road.
Welcome to another RT interview. Today I'm excited to have returning guests, Mr. Tekoa Da Silva, a market analyst as well as researcher and investor. And today he's joined us to share his thoughts on a variety of subject matter and in particular opportunities out here in the markets, given the current world we're living in. And so as always, it's good to connect with like-minded individuals that not only is aware of what's happening, but also looking for opportunities in the space to educate you, the viewers. And so let me bring them in here right now. Tekoa, how are you doing, my good friend?
Oh, I'm doing great. Nice to see you again, Mike. A pleasure to be with you.
Yeah, my pleasure, man. I'm looking forward to connecting as always. And as I mentioned beforehand, it's always good to connect with people who pay attention to a variety of subject matters. And more importantly, your unique skill set is looking for opportunities. And that's why I really appreciate you joining us to share your thoughts and as well as analysis. We got a lot of interesting graphs and charts that you're going to present to us to pretty much lay out a case as to why there is and might be more untapped opportunities out here for people, depending upon what they're looking for and their level of risk as well. So at this current moment, I like to start off with just getting I guess a framework as to what you're paying attention to. And so from where you're seated at, what you're paying attention to, what concerns you, excites you about this current environment we're in now?
Well, there's a lot of noise in the marketplace. There are a lot of distractions, and I think for anybody who enjoys as a hobby looking at the financial space, I think it can be very easy to be swept up with the popularity of social media and Trump's tweets and the impact of the market that those tweets have. It's pretty interesting to follow, and the price volatility in the market that comes with it is it's pretty fascinating. But what I tend to do, as a real a hobby, is I kind of like have gone back into my childhood years where I used to collect. I used to collect baseball cards. For anybody watching that used to collect sports cards, I remember what I used to do is I used to like looking at the little numbers on the back. One of my favorite numbers was the batting average, and I used to compare all the cards to see which of the players had the highest batting average. And it's kind of easy. You just look to see which one has the highest percentage. And then you can arrange your cards by batting average and then trade them with your friends and kind of do that. So I've come to the opinion that financial markets, people can look at financial markets in a similar way. There's very common pricing metrics that people can use that are similar to batting average for a baseball player, but it's something different for a company. The very common ratio that people use is the price to earnings ratio, which takes the annual net income of a company and compares it to the price, the market capitalization that the price is being offered at in the market. And there are probably about 15 or 20 of these metrics that can be used. Just like looking at the back of a sports card, there are 15 or 20 different metrics that can describe the performance of a sports player. So that I really have a lot of fun looking at and sort of enjoying as a hobby. And the nice thing is that just like a baseball player, can be ranked, if they're playing in the United States, that a baseball team that's playing anywhere in the world, whether it be Argentina, Indonesia, China, or Vanuatu, the same metrics can apply. So it can be a fun way to look at the world that can be applied internationally. And then second to that, a pretty big hobby of mine that I know that you and your viewers share is learning about and watching precious metals over time. And I know we talked a little bit about that last time too. There are some very interesting things I think going on in the precious metals marketplace, especially as a person can compare precious metals, and let's say specifically gold, to the pricing of other things around the world. So having multiple ways of looking at the world or different perspectives, I think can help make sense of things despite all the noise that we may be distracted by.
Right. Good point there. And I am also myself, or I was in my youth, a card collector, comic book collector, and I was always fascinated with just the I guess the scarcity of things. And so when I looked at comic books in particular, whenever they come out with a limited edition, the one of whatever, or those things really excited me because I perceived the idea that one day there will be very few of those in circulation. Therefore, I might have a little, a bit of a something on my hands there that might be worth something. And so here we are today, talking about a variety of subject matters. And as I was looking, our last time we connected was last summer, and I had hair then, but we were talking about currency devaluation, and you put together some very interesting charts. And this is well before silver and gold responded the way that they are in this current environment now. And so it really led me to just want to reach out to you because you were spot on with the valuations of silver and gold then in reference to them being ultimately low when measured against other things. And I believe one of your talking points was using gold and or silver as the primary denominator when you're comparing it to the valuation of other things. And that was that angle there really stood out to me. And so here we are now. We're seeing gold and silver go up, but yet there's a lot of other things around the world that also can be measured against them, and they are well below what you perceive to be much higher prices in the future. And so gold and silver, a lot of people here are used to just buying and holding, but you also look for opportunities in other commodities and other areas and other sectors. So I guess what led you to, I guess, look for those type of opportunities, and how did you educate yourself to go about doing that?
Well, gosh, I guess two things come to mind. The first is, I had a conversation with uh, a statistician or researcher. He's the publisher of the ShadowStats publication. His name is John Williams. Just absolutely brilliant, brilliant man. But what he does is he compiles his own version of the consumer price index using the methodologies that the U.S. government used to use and publish back in the 80s and 90s. He still publishes the original methods, and the reason he does that is because the U.S. government has made modifications to those measurements over time, and the argument is that they've removed over time the items that are telling the truth about inflation, so that over time the CPI measurement can be sort of benign with its growth, which would understate inflation and understate other government agencies use the CPI index, so it understating inflation has certain political advantages. But this is something that John Williams talks about. So I asked him. I said, "Well, John, if you take a look at your compounded calculation of the CPI, the way it was originally composed, and compare it to the price of gold, is there a correlation between the two over time?" And he showed me a chart of his work showing nearly identical price performance with the price of gold over time and the compounded CPI. And so that basically just means that if inflation is compounding at 5% per year or 10% per year, real true inflation, that the gold price will tell the truth, and it will match, let's say, point for point, and move up in a sort of a mirror-like fashion. And so he said, if you want to know where inflation is going or what the true measurement of inflation is at any given time, look at the gold price. And what is fascinating is about since the last time you and I spoke, which was about a year ago, I think the price of gold per ounce at that time was about $2,450, so just over $2,400 an ounce. Today it's about 4,000, and that's down from close to 4,400 about a week or two ago. So it's nearly doubled in about a year. And I've sort of been fascinated with gold for the last 25 years, basically my entire adult life. And I don't think I can ever remember a period in which it's moved up so quickly in such a short period of time. And there's all kinds of I guess, problems going on, politically in the world, today in terms of war, et cetera, that could be contributing to that price rise. But, also, I think it's probably just the expansion of the money supply and the currency. So, that's a thought that comes to mind. And then the other thing that's, caused me to think so much about it and be so interested in it is because, you know, I've read books about the stock market and things, and I've sort of been a little bit of a student during my adult life about the stock market. And a lot of people say that, well, the during the Great Depression, we had this huge, market crash in 1929, where the major equity indexes went down about 90%. And some people say that could happen again. But then, it's kind of obvious, and you're a precious metals guy, so you know this already. But the money that was in use back then, and the indexes that were measured, represented by the U.S. dollar, which was a different currency back then, they meant something. The money meant something different. It was, a silver coinage was being circulated, and the U.S. dollar was exchangeable by fixed amount for gold. I believe it was about 32 and change, or about 31 and change per ounce of gold as a fixed exchange rate. So anybody measuring the price performance of anything back during that time period has to keep in mind that it's actually the gold price is playing a role in that too. But since that connection was severed, I believe it was 1971, the US dollar has been moving freely, and the gold itself has been disconnected. So, how can we know the real price of anything if we don't have a reliable measuring tool? And the US dollar, the pool of US dollars and the pool of total credit in the world just seems to be expanding at a never ending pace, at an accelerating pace. So I thought, wow, in order for me to really figure out what's cheap and what's expensive, you go to the store, or you go to the marketplace to buy something. You might be looking at a car. It might be a used car, let's say for $20,000, or you might be looking at a bag of apples. They're both going up in price. One at, let's say, a 20% rate on an annual basis, the other at a 5% rate on an annual basis. What's cheap and what's expensive? How can a person figure this out? And I heard somebody, this commentator, whose name is escaping me, but his family survived in one of the Eastern European countries during a period of hyperinflation. And he described the story about how his family was using the gold price to measure regular things around them, like the price of land, let's say coffee, things like that they consume, to really know what's really cheap and what's expensive. Because when the price of everything is accelerating at a differing speed, it's a reflection of the loss of purchasing power, the very rapid devaluation of the currency. But anyways, to sort of sum it up, another hobby of mine has the other thought that comes to mind is measuring things in the price of gold, and we can do a little bit of it, of that today.
All right, sounds good. Looking forward to it. And also, as a reference for what you're referring to, your interview here with John Williams, we're in a dangerous circumstance, risk of hyperinflation ahead. And so, definitely, John Williams, I follow his work. Never had a chance to actually speak with him, but definitely, he's always referenced as a person who his stats is more in line with the true figures that we should pay attention to, and not the current figures that we have now. So, definitely a wealth of knowledge right there to check on. So also, this is your YouTube page here. So for those who might be interested, I'll definitely let people see what's here. And so just type your name in, and they'll find you right there to get more of your analysis here, because you did a good job putting together some educational series that I actually got caught a couple of them. So appreciate you for sharing your wealth of knowledge with the viewers as well. Now moving ahead, let's just jump into some of the charts and just see where we can go with them in reference to laying out some opportunities, as well as some different metrics that you have come up with to give us a guide or a gauge to get some real valuations from. So let me get my screen together here. And so we'll walk our way through it. And so feel free to just take it away and let me know where you want to go with this. So oil in the emerging market priced in gold. And
Sure.
so make sure to give a disclaimer. So take a minute, pause the video, read over it for yourselves, just because this is for education's sake, not financial advice, as always. Gotta make sure we put that out there. And let's just start off with the very first slide here, if you don't mind. Give us your thoughts on putting this work together here.
It's so fascinating. People like looking at the price of gold, on a price chart and getting exciting about it. Wow, the price of gold is going up. Let's get excited. But the one fascinating thing that I've found is that if you flip the price of the price chart of gold over, it's showing you a reflection of the purchasing power of the U.S. dollar. And I think it's really concerning. This chart that we're looking at right now, this is from a year ago when you and I last talked, back when price of gold was 24.50, and it looks like a cascading waterfall. If anyone has seen the price charts of the Roman currency, the denarius and the silver content and the collapse of currencies over time, this looks like mirror image, just like it. And if we go to the next slide, it just continued. Here it is, the price of gold, about 4,000 plus, and it's just falling off of Niagara Falls in terms of the purchasing power of the U.S. dollar. So when I see this, I say, wow, it's really gold and silver, and now platinum and palladium are joining, but they seem to be, from a price performance standpoint, going up faster than a lot of other things. And I think that it's a warning sign for possibly much higher rates of inflation ahead.
Yeah. Now, speaking of inflation, we have, of course, the Fed FOMC meeting and things of that nature, where there's an anticipated rate cut. At the same time that the mainstream media will have us believe that the economy is going good. Treasury Secretary Besson comes out, said that jobs and everything couldn't be better. The economy's strong. The beautiful bill is doing. And so all these narratives that were being given, and so you have two different camps. You got Main Street, and you got Wall Street. Wall Street has done quite well. Main Street on the other end, I would disagree with a lot of the position that people are in right now. But gold doesn't lie. The charts doesn't lie, and of course silver, and then you mentioned the other metals as well. Then you got the rare earths and things of that nature. So this is just a reminder for people to realize that just pay attention to the activity, pay attention to the numbers, because they tell a much different story than what we're being sold. But I digress from that, so we'll stick back to this. But let's keep it moving with this one. So Brent crude oil price in gold, January 1960 to October 2025. What is this telling us?
So last time we talked, I had like 20 commodities, and there was just way too much. So I just narrowed it down to one today. But this same sort of illustration is replicated across the agricultural commodity space. And what it is, in simple terms, is it's taking a commodity price, dividing it against the price of gold, and flipping the chart, inverting it when necessary to show either the price of gold related to a commodity or the commodity itself priced in gold. And so that's the way that I've enjoyed looking at these things now. And this is a chart of Brent crude oil priced in gold. And if our currency was still the way it was back in the pre 1971, the price of oil would look more like this chart today, and the price of a lot of other things would look much different, because it would be tied to, the currency would be tied to gold. So what I think is interesting are historical price extremes, because occasionally they can revert, and they can revert in a very strong way. A couple recent examples that come to mind are the silver to gold ratio, where a lot of people participated in silver when I think the ratio exceeded 100 to 1, the gold to silver ratio. And then the gold to platinum ratio also hit a 100 plus year extreme just a number of months ago. And then platinum went on I think a 40 or 50% move higher. But what's really interesting is that about 2 weeks ago, the price of crude oil and the various crude oil products, when priced in gold, reached the lowest point that they have shown in going back 65 plus years in terms of the data that I was able to get from the World Bank. The only other single instance in which they were cheaper was the April 2020, the COVID crash, when for a very short period of time, all energy-related products were extremely low. Depending on which energy product you look at, if you use the monthly average, we've matched or come very close to that April 2020 COVID crash bottom. What's really fascinating was that the only other precedent in this 65-year period, aside from the April 2020 COVID crash bottom, was about June of 1973. And that was just mere months before what was then also a Middle East conflict really broke out, and the Arab countries started something of what was referred to as the Arab oil embargo against select Western countries. And within a matter of months, the price of oil exploded, late 1973. And there was also a very strong price recovery following the April 2020 crash. So will that happen again? Who knows? I don't know. It's just an observation about about a price extreme. And then, so that's on the bottom. I also looked at what was the price extreme recorded on the high side at the top, and that was about 2008. Uh, just amazing. You go back to 2008, and the price of oil was north of $140 a barrel, and but you look at the price of gold per ounce, and it was somewhere around $950 an ounce. So really a different setup. But when you look at that chart, the ratio of Brent crude to gold, it peaked out at approximately 0.149 or 0.15. So that would mean that a 0.15 uh, in terms of a quantity of an ounce of gold was able to purchase a barrel of Brent crude oil. So if you apply a similar ratio today at a $4,000 approximate per ounce gold price, it implies a vastly, vastly higher price per barrel of oil, something like 9x plus. Do I think that will happen? I'm not suggesting that it will. It's just an observation about the historical relationship. But you never know. Markets can show very extreme things at times, and given the way that the geopolitical and the war scenario is in the world today, shortages can occur. So it's just something I think to be aware of.
Wow. Now, just to think of, a barrel of oil being 9 times approximately higher in price, like, that wouldn't be a world that would be very comfortable, I don't think. Like from a day-to-day life aspect, but just doing things when it comes to, filling up your gas tank or just overall heating your house or things of that nature, like it would be very costly. And so that would lead me to wonder, like, what type of environment we'd be in if gold was at the center point of everything. Once again, as a monetary medium, and based upon all the activity we're seeing, this current demand in gold, different narrative, different places. We got the Shanghai Gold Exchange looking to do things on the physical side. We got the LBMA and the COMEX doing things on the paper side still. And so, I guess, what's your take on this sudden surge? Is it tariff driven? Is it just a demand for physical, or is it perhaps more than what meets the eye? What are you thinking?
Well, Mike, to be frank with you, I don't know. There are billions of participants around the world that are impacting the pricing of things every single day. I know what the very popular narratives are in the market, that central banks and governments are now stocking up on gold and replacing their reserves, or moving out of fiat currencies and out of the US dollar and maybe US treasuries in particular, and more into gold, and possibly will increase that allocation in the future. But I think it involves a lot of other things: expansion of credit, not just in the US, but worldwide, money printing in its various forms. And the geopolitics is a real wrench in the machine that, in my short lifetime, I don't remember any other instances that seemed as intense and as close to potential blowups as what we seem to have today.
Right. Now, to look for, I guess, opportunities when you go beyond the Western borders and the Western-led markets, S&P 500 all-time highs, all these metrics that we're given over here, one would think that they're priced out of opportunities because some people say it's bubble territory driven by the AI. Who knows? But the PE ratios of Western-led companies are extremely high, to the point where some consider them, overvalued extremely. But then again, there's opportunities beyond our borders, and that's where we want to take the viewers now. So I want to bring up just the emerging markets, EEM, ETF, and USD. So walk us through this process here, and let's get to these opportunities that you foresee, perhaps.
Sure. So, getting back to the whole concept of baseball card or sports card statistics that you'll find Um, a couple common statistics that people use to measure equity indexes are things like price to earning ratio and another one called price to book ratio. But I mention that now because that'll come up in just a couple minutes. But
Mhm.
this is what we're looking at right now is a price chart of an ETF. The ticker symbol I believe is EEM. It's the Emerging Markets ETF. This price chart is denominated in US dollars. And over the course of the last, let's say, about 15 years, 10, 15 years, it doesn't look like it's done very much. In fact, it looks like it's just now about to breach its 2007 price top. I guess I should also quickly add that for anybody who looks under the hood, so to speak, at emerging markets, the valuation of their companies, they've been in a bear market for 18 years on average. So for 18 years, their stock prices have been languishing. And they have been declining and or going sideways in price. But somebody could also say, well, hold on a second. 55.73 today, a price for that ETF, and 55.73 from 2007, that's not the same money because the US dollar back then was much stronger and the gold price was much lower in US dollar terms. So today, 55.73 is worth much less. So how can we get a real price of this ETF? And that's a fun habit that I've been developing when wanting to look under the hood, so to speak, is to measure it against gold. And so on the next slide here, we have the same ETF measured against I think it's the GLD ETF or the actual price per ounce of gold. And it shows a fascinating picture. It looks different. After we had that 2008, 2009 financial crisis and crash in markets, this chart shows a different picture, which is a languishing price bouncing up and down over the course of about 10, 15 years. And interesting is that if we were to zoom in on this chart, we would find that it was in April earlier this year, April of 2025, and then here just now about a week or two, a couple weeks ago, that this particular ETF, when measured in gold and measured in real money, has produced its lowest point. One could try to call it a bottom, but one never knows if it will go lower relative to gold. But it's demonstrated its lowest point in this last 18 plus year period, just this year.
This definitely yeah, it gives it a much different perspective than the previous one where, if USD was at this focal point at the center of everything and used as the denominator for I guess true value discovery is what we're going to be more so focused on moving forward. Gold definitely tells a different story. So we, I guess, potentially haven't seen much, haven't seen anything yet. And so here we have emerging markets are still cheap.
Yeah, these numbers that on the left-hand side, where there's a little list that says underneath by PE ratio, these numbers were a little bit lower. Last year when we talked, but there's been a little bit of a a fiat currency price rally across these markets, but that price rally has been way exceeded by the US dollar fiat currency price rally shown in gold. But this list was taken from worldperatio.com. It's a fun website where you can look at various countries and get a sense of what the basic stats are for their stock markets. And I should add in here too that there's an ETF where it's not a recommendation, just informational purposes and education only. But where this ETF, I think that the fund managers there actually do a pretty good job selecting what are statistically cheap companies, and that ETF is the Emerging Markets High Dividend Yield ETF. The ticker symbol there is DVYE, and the stats are on that slide. That PE ratio, it's a big basket of companies, but the average is about 8.5. And if you look backward about 10 years and you look at all the dividend receipts that ETF took in from the underlying companies and compare it against the current price, the 10-year average relative to the current price is about 7.25%. So a person could say that possibly over the next 10 years or over the next, let's say, handful of years, that 10-year average, could it be replicated, year by year? that may be the case. I also think that there's the possibility that a lot of these companies will take in larger revenues and larger net incomes as a consequence of the devaluation of the currency that's occurring all over the world. So there's the possibility that a dividend yield could be dragged higher by inflation over time. So this is just a snapshot of emerging markets. If you look at any one of these companies, like opening up a big box of baseball cards and you look at all the different cards of the different companies inside each market, you'll find that a lot of them are, you know, 6, 5, 7, 8, 9, 10 times earnings. A couple of them from time to time might drop as low as 3 times earnings. And when you look at some of the sort of sages of the market or the gurus of the market over the last 100 years, Warren Buffett, Benjamin Graham, his mentor, as an example, they used those metrics as a measurement, one of many metrics to use to try to identify cheap companies, things like PE ratio.
All right. Now, that definitely paints a very unique perspective that the average person may not be aware of or in tune to. So it just highlights more of the potential opportunities outside, the Western borders. And so, for those who are interested, definitely do your research, dive deeper, and just try to get an understanding of the potential for greater gains in the future, especially based upon, fiat debasement, which is clearly going to come at some point on a global scale. Then also just measuring that against true tried and tested money, aka gold, as well, will give you some very good gauges to measure along with. Now, let's get to the next side of things in reference to some case studies here. It looks like you get put together a couple case studies for us. What are we looking at with these?
Sure. Yeah, there's about 5 of them here, and we can just go through them really quick. So,
Mhm.
getting back to that question of oil being a very statistically cheap commodity relative to gold. What's interesting is that if you look at energy and oil companies around the world and you look at their current price relative to the past 10 or 20 years of their financial performance as companies,
Mhm.
many of them are showing statistics that would suggest that they are at one of, if not if not the cheapest sort of time period in this last decade or two. And
Mhm.
this is one, as an example, China Oilfield Services. This is the largest China Oilfield Services company. And back of the card stats for this one, the if you take the last 5 years of their earnings and compare it to the current price today, you'll have a PE ratio of just over 12. If you take a shorter earning time periods, let's say the last year, or if you estimate for 2025, it'll likely be closer to 8 times.
Mhm.
So that 5 year period captures that COVID crash time where oil field spending by many energy companies simply plummeted and their earnings plummeted as well during that short period of time. So it's
Mhm.
captured within that 5 year period. And the 5 year average dividend yield is also a little bit on the lower side because it captures that period. But it shows that I think the strength and resilience of a big company like this, and you could compare it to a basket of companies, this VanEck Oil Services ETF, that has simply higher stats.
Mhm.
Um, where the PE ratio for that basket of companies is about 13 and the dividend yield is just under 2%. So I think this is, I could go on about it, but maybe we'll do that another day, that
Mhm.
US equities, from a valuation, a statistic standpoint, are 2, 3, or 4 times higher in price relative to emerging markets and relative to a lot of individual companies in the emerging markets.
Mhm. All right. Case study number 2.
Yeah.
What are we
So
looking
this
at
is,
with this?
I think, a very fun one. And I should also point out, I've got charts here for all these 5 companies. The
Right.
chart at the top shows the fiat currency price over time, but the chart
Mhm.
underneath it shows when you price it in gold. And for all of
Mhm.
these 5, the f- price when you price the security in gold, it's showing itself to be at or near an all-time low. And the time frame we have here is about 10, maybe 13 years. And I think for all of these, it's showing an all-time low when priced in gold. But when you price it in the fiat currency, which is becoming weaker over time, they're either going sideways in price or slightly higher. But using gold, I think, is just an extra fun tool. So China Petroleum and Chemical Corp, largest Chinese oil refining and petrochemical company. The stats here are, I think, a little bit richer because This is a diversified company, a different business than oil field services. But the 5 year average of price to earnings, the ratio is just over 8. The 5 year average dividend yield is about 8.5, and you compare that to the basket of companies in the U.S. Energy ETF
Mhm.
that I have listed there. And I've looked at these American companies one at a time, and it's about average that the big, large, diversified American companies are a bit over 15, 16 times PE ratio. Dividend yields, between 2 and 3%. Some are a little bit higher than that. But this is an example of China Petroleum and Chemical Corp, where the stats on the back of the card are just simply much higher.
Right. And then we have Eco Petrol.
Yeah, the
I'm saying that
next a
correct?
couple examples I think are a bit extreme, and that is
Yeah.
here's another energy company. This is the largest Colombian energy company, and I think it's a very wonderful business, but it
Mhm.
has been expanding into Latin American infrastructure, pipelines, power lines, highways, toll roads. And both the price chart in fiat currency as well as priced in gold, it has just languished over the last 15 years. And of course, when priced in gold, it is at or near an all time low. But when you look at these stats, the 5 year PE ratio is about 4.5. When you read the value investing sort of greats, and they
Mhm.
talk about some of the best bargains that they've observed over their careers, they talk about things that are 2, 3, 4, 5, 6 times earnings in terms of a PE ratio, not just the
Mhm.
last year, but a handful of years. So you get a real fair representation of its earning power. And not to say that this, again, it's just educational purposes only, but this is a case study where you see that kind of figure. The 5 year average dividend yield is showing north of 15% because it captures a couple of the real gangbuster years just after COVID where the company earned a lot.
Mhm.
If you look at a longer time frame of 10, 15, or 20 years on their dividend yield and compare it to the current price, I think it's probably fair to say that they're probably closer to 11 or 12%. So could it be safe to say that over the next 5, 10, 15, or 20 years, will the annual dividend be 10, 11, or 12%, possibly to be dragged higher by inflation as well? One will have to wait and see. But looking at the energy ETF comparable here, you see stats that are just much higher. I know Ecopetrol is a smaller company; it's not as big and diversified and as the companies inside the iShares U.S. Energy ETF. But just as a sort of loose comparable, it's compared against 15 and a half times PE and a just under 3% dividend yield for the U.S. comparable.
Interesting. Very interesting. Banco do Brazil.
Yeah, if you go to Brazil and I guess other Latin American countries these days, I know for firsthand experience in Brazil, you walk down the
Mhm.
street, out of 5 or 6 bank locations, you might see 2 or 3 within a 5 or 10, 15-minute walking period in an urban metro area. So Banco do Brazil is
Banco.
everywhere in Brazil. It's the second largest Brazilian bank and second largest Latin American bank. This was a fun one for me, given my travel experience in the country. And
Mhm.
the fiat currency price chart is just showing a sideways performance over 15 years. Priced in gold and real money, it's showing itself to be just a little bit lower. So it
Mhm.
uh, just a bit above its 2020 crash bottom when priced in gold. But again, very extreme price valuation metrics shown here. 5 year PE, average PE ratio, under 5. 5 year average dividend yield, a bit over 10%. There's going to be fluctuation in their earning power because the agricultural sector is in recession, and a good
Mhm.
portion of their earnings come from the agricultural sector. But getting back to the question of what commodities are the cheapest, especially when measured in gold, agriculture is right at the
Right.
top of the list. So I think as the agricultural pricing worldwide recovers in fiat currency terms, I think it will. Uh,
Mhm.
the businesses that they lend into will probably do much better, and so I think they'll be representative of the Brazilian economy going forward as commodity prices recover. But if you compare those basic stats to the S&P U.S. Bank ETF, uh, it's twice the U.S. Bank ETF is about twice as high. The PE ratio is a bit over 11. Current dividend yield, about 2.3% versus the probable 10% that Banco do Brazil is probably going to deliver in the years ahead.
Mhm. And then the last one here, we have Thai Oil Public Company.
Yeah,
We stand with this one.
Yeah, I was very fascinated by this one. Look at the price chart in fiat currency, the Thai baht currency. It's gone nowhere in the last 15 years. You price it in gold, it's just months away from its extreme all-time low in the last 15 years. But
Mm.
it's Thailand's largest oil refining petrochemical company. Uh, one, if one were to look at the market, uh, at the security in the market for this company, Thai Oil, they would find that it only trades in sufficient liquidity on the Thailand exchange. Um, just pointing that out. But the 5-year PE ratio here, compared to the current market price, is just a bit over 4, and 5 years of dividend yield compared to our current price today is about just under 8.5. And you compare that to, let's say, the American uh, oil refining ETF, whose basic stats are shown at about 19 times PE ratio and a dividend yield of about 2.75. So another extreme outlier in terms of something that appears from a back of the sports card standpoint to be very statistically cheap, in absolute terms, especially relative to its um, American peer company basket.
Interesting. So, looking at just those 5 case studies there, as well as the previous examples provided to us, there's one common trend. Fiat terms, things can go either laterally or trend upward with the perceived notion of value. And measured against gold, it's always the opposite. And so, when and if there's a reversal of things based in gold trending back upwards, everything else that is really necessary for life, for the most part, commodities, metals, rare earths, you name it, those valuations will also have to adjust as well, aka the fiat prices of those. And if and when that takes place, Tekoa, what type of what type of not necessarily what world will we be in, but what type of financial position could some people be in had they taken advantage of these type of trends here, in your opinion?
Well, I'll put it this way. Two thoughts come to mind. The first one is if somebody was uh, watching this and went out and did their own research and they consulted with their own financial advisor and did their own due diligence, and they found the company that was trading at 4 times earnings, annual earnings, that is equivalent to a 25% annual rate of return if they bought the entire business.
Mhm.
So a person could theoretically say if you buy an entire company at 4 times earnings, it will pay you back your entire purchase price over a 4-year period. Um, so that's, I think, how those statistics should be thought of when looking at valuation of companies from that, kind of Ben Graham, Warren Buffett standpoint. But when it comes, the second thought is when it comes to inflation, I think the concerning thing about that gold price chart and the plummeting value of the US dollar relative to gold, the concerning thing about that is that a lot of other commodities, as we're talking about here, are not showing price explosions. And I think that there's the possibility that could occur in the future. And I think what is concerning is oil and the refined products that oil creates, such as gasoline. I took a look at the US dollar, a fiat currency price chart of gasoline by the gallon, and it's at the same price today that it was in 2005. It hasn't gone up in 20 years. What could there possibly be when I look out the window? I'm based in the US at the moment. When I look out the window at the price of everything, I don't see anything that's the same price that it was 20 years ago, except for a couple things like gasoline, a couple, food products. Um, and so, what will the world look like? I think for people in the Western world, uh, I think that the the cost of living and price inflation could really get out of control and probably become very bad. If what we're talking about, if there's a reversion to the mean in the real price of oil, and the real price of things like gasoline and food products, if that happens, what we've seen so far could be dwarfed by the type of inflation that could be down the road. So it's not very fun to think about, frankly. But for those people out there who talk to their financial advisors and decide to to take their fiat currency money and exchange it for something real. I know that you cover precious metals in a very, very good way. So that's something I guess that people can continue to learn about and do with you. But other things, if they can exchange that money for an asset that that will hold its value and can't be printed away, like paper money, I think that gives them the best chance, to shield themselves. Or at least when you read the books about when inflation has occurred in the past in various countries around the world, that's how people survived. They got rid of that money as quickly as they could, and on a sort of micro basis, people would exchange it for that fiat money for large quantities of food, pantry bulk food items. That would keep for very long periods of time, so they wouldn't have to be stuck holding that money. Is it going to get that extreme for holders of U.S. dollar? Who knows? But it's certainly concerning what we've seen so far.
Well, Tekoa, as always, it's good to connect with you and to have you break down a variety of graphs, charts, stats, and give us some PE ratios and the whole gambit of very specific and detailed information when it comes to potential opportunities, as well as a different way of looking at how we perceive value. And so I thank you as always. And I'll also bring up on the screen here where people can connect with you at. Here you have you on X at Tekoa Da Silva, and then of course you over on YouTube as well. As so, definitely for those who are tuned in, check them out. Go show them some support and learn a couple new things as well, because I definitely am a subscriber. So I appreciate all the work you do. Any last thoughts? Any words of wisdom to part with before we say goodbye?
Well, we need to start rethinking the dollar, paying close attention, and I'll be following your work. And thank you, Mike. It's a pleasure to be with you again, and thank you to your audience for your time.
Yes, appreciate you. And as always, for those who, if you enjoyed this, definitely drop a comment down below. Go show some love to Tekoa on his websites and socials as well. And other than that, just stay plugged in, stay informed, and of course, love, live, learn, laugh, and enjoy life, because
Yes, sir.
it is still a blessing. Catch you guys later.